Hi guys, thanks for tuning in to another episode of Nuggets News, or our monthly housing and economy update with our friend Martin North. How are you, Martin?
I'm pretty good. I'm hanging on to the sides with my fingernails just sort of sliding down, That's about how I feel at the minute.
It's a little bit like that, and we couldn't get our September episode out on the last day of September on Friday. We had to push it back a couple of days, but it was a little bit timely, as we were just saying before we started there, as it's been a pretty chaotic weekend. Markets have just opened, and I think it's going to be a huge 24 hours.
Yes, I think actually this next month, it's interesting, as we'll see in a second. October is often a wobbly month on the equity markets, but there are so many other sort of things sliding around below the surface. And wherever you look, there are more question marks than answers at the moment. So, yeah, it's going to be a bit of a ride, I think.
Yeah, so we'll work through a lot of the stuff that's happening around the world today, but anything in general you want to mention before we get into it all?
Well, only that I think that it's worth just bearing in mind that central banks can potentially do quantitative easing whilst lifting interest rates. They don't necessarily have to point in the same direction at the same time. And if you think of what happened last week with the Bank of England, we'll get into that shortly. They've done some quantitative easing to save a particular financial stability issue. I expect to see a lot more of this, but that doesn't necessarily mean that we're going to see massive interest rate pivots. In other words, cutting interest rates again, like they did previously. We could actually have both. And that actually changes the perspective a lot because it means we could still have higher interest rates and quantitative easing to fix specific issues.
Yeah, I agree. And I think even a step further, if the particular central bank, like the Bank of England, has to start conducting these massive rescue operations and it's going to hit their currency, I think we could even see the king of all the central banks, the US Fed, start to come in and almost try and help them defend their currency by them taking the hit and them expanding their balance sheet. So we're going to see we're not going to cut rates, but we're going to do QE, and we can't afford that foreign, the currency crisis to happen as well. So I think we're going to see this game of chess about moving the risk, and ultimately, it all ends up probably with the Fed having to print trillions of dollars. I think.
Well, it could well be, but remember that they've got these swap lines. So there's international swap lines between central banks. So this is a global problem, not just a local problem, which is why it's so critical to understand below the waterline. All this plumbing is actually going to be significant. And the Federal Reserve, frankly, is calling the shots. Like it or not, what they do in the US determines pretty much everything else.
Yeah, absolutely. Okie dokie. Let's get into these brilliant slides of yours as always. So, people have been talking about this as being the most aggressive hiking cycle in history.
Yeah, this is amazing. Just to underscore how aggressive it is. You compared 2022 with the bond market crash of 94, 95, or the dot-com crash, or even the Eurozone crisis, or even the temper tantrum. This is never been done, right? This is so fast from such a low base. And there's no way, given the lags, that the Fed knows what has been done so far. It's too soon to know. And yet they're still talking about lifting rates, and the markets are saying another 75 basis points next time around. So that's a shocking thought.
Yeah, and just keep in mind for the people at home that this is the most aggressive, but we've got more debt than any time in history. So moving this aggressively, 3% doesn't sound like a bigger number, but 3% now compared to when global debt was maybe 10 trillion and whatever it is now, it's just such a different story. And that's why we see everything breaking so much faster this time around.
Yeah. And remember that it's from a very, very low base. So if you think about what the real percentage change is from what that original base was, right, it's massive. We've never seen that amount of movement.
Yeah, well, you can't do the math on what the percentage change is from negative rates to these positive rates, but I know what you're saying, man. Yes. All right. So next up here, history often does rhyme. So there's a long way to go if we want to compare to historical bear markets, but at the same time, it's more aggressive, so it could be worse but over faster.
Yeah, and I'm not saying that we're going to see precisely the same play as we saw in 2008, but it is worth just reflecting that we have been tracking the trajectory relatively similarly, and yet, if anything like 2008 happens, we've got a significant further correction in terms of the markets ahead. And I don't see any reason why at the moment we shouldn't get that further slide. So if you think the slide is over, just bear in mind that history sometimes rhymes.
Yeah. October tends to be a negative month, but just in conjunction with the last slide, the next leg down was that Lehman moment, and obviously this morning all over crypto Twitter and in the news, we've got Credit Suisse and Deutsche Bank, and they're coming out and saying the same things that we heard from Bear Stearns about, everything's rosy. I think central bankers are going to be aware of that next leg down we saw in the chart, and they're going to have to do something to because markets are going to implode worse if they let the same thing happen this time.
Well, that's true, and the rumours are rife, and it's worth just reflecting on many of the big investment banks have got very leveraged positions. They've got, of course, a lot of derivatives, and high volatility means that you could be on the wrong side of the trade, and the bond markets are so critical to understand here because a lot of the financial plumbing is based on what happens in the bond markets, and as we'll show in a couple of slides' time, the bond markets are in crisis, both from a liquidity perspective and also from a rate perspective. And I suspect that we are going to see further cracks in the financial system. Then the question becomes, what will central banks do? How will they prop them up? Because, of course, many people would argue that the Lehman's rescue was a mistake. Should have actually let things crash. So it'll be interesting to see whether they try to prop stuff up again or whether they let stuff crash. That's the question.
We might talk about the size of those rescue packages and what it would take now in the equivalent as well. But that next chart you've got there, Martin, is that October tends to be a pretty volatile month.
Yeah, so if you just look historically speaking, October is the month. It's often called the October effect. If you think of the global financial crisis, if you think of the earlier crashes, on in history, they all tend to happen in October, right? Which is unfortunately suggesting that, like it or not, October is the month to watch. And, putting everything else together, I think we're in for a really bumpy ride this month. And anybody who thinks that we've hit the bottom, forget it, mate. It's going to be a really, really bumpy ride.
All right, so we've got I've seen a few different charts on Twitter as well as in terms of the put to call ratios, and this is one of the retail buyers, but the put premiums are going up, so people are trying to buy that protection against the downside risk.
Yeah, the interesting thing, these are retail investors, right? So the why I picked this up was it's really important to understand that over the last couple of years, a lot of retail investors have gone into the markets for the first time. That was partly because of all the government handouts and everything else, all the stimulus packages. Now, a lot of them are really nervous because they're seeing the value being swept away, and they're now being enticed, I would argue, into options and effectively on the put side. Huge volumes, huge premiums. But of course, the problem with those is for every put, there's the other side of the option, which means other people are going to get caught because, of course, there's unlimited risk if you're on the other side of the put option call. And that's the problem, really, that essentially we've got these derivatives sitting above everything else. And the one-to-many relationship between the underlying and the derivatives means that any move, particularly volatile move, is magnified dramatically. And we don't know where those things are going to hit. So this is one to watch.
Yeah, and if you want to put your contrarian hat on here, you'd say if retail traders are flooding to buy these put options, as you say, it tends to be the more commercial banks and that are selling put options to them. So, and they're the ones that tend to normally fleece retail. So this is maybe a contrarian signal that, hey, maybe we could get a bounce here, or retail could get these positions closed and not make money before we head lower if we are going to.
Yeah, and it's hard to know because it's just fascinating to see how much volatility there is and how many trades are going on. And these put options, a lot of people who I think are touching put options have no idea what they're getting into.
Yes. All right. So the bond market, as you touched on before, really important, and we've seen volatility in the bond market, and more so than the stock market, which is unusual.
Yeah. So just to give you some numbers, there's close to 30 trillion US of bonds globally, right? That's a big number, right? 30 trillion. And the volatility in the bond market, this is a volatility index in bonds, is way through the roof. It's 148, right? Now, interestingly, the volatility index for stocks, this is based in the US, is high, but not dramatically high. And many people will say, well, you're not going to see anything like a bottom until the volatility index for stocks gets to maybe 36 to 40. But this volatility index for bonds shows you we've got a real big issue in the bond sector, right? And what happened last week with the Bank of England is a symbol of a much bigger issue with regard to bonds. And if we look at the next slide, this is the key point. Liquidity in the bond markets is dropping. Now, liquidity means how easily can I trade, and what are the spreads that I need to get if I want to trade. And what we're seeing is that across the continuum, the amount of bonds going in the market are dropping, which means that the spreads are rising. And it also means, of course, that the yields are rising, supply, demand, all of those things. And the prices are, going all over the place. Prices are dropping actually quite significantly. So this is a really, really important thing to understand. This is the financial plumbing. This is essentially what's underpinning pretty much all of the financial system. And this is a huge, huge, huge amount of risk in the system now. And of course, the bond markets, I think, often lead the way relative to other markets. Equities tend to sort of truck along afterwards sometimes. So what's happening in the bond markets is dead important. And if you want a sort of a specific case study, go on to the next slide and look at what happened with the Bank of England, right? So we know that the UK government announced just over a week ago policies that essentially was going to borrow from the markets to cut the highest rate of tax in the UK at a time when the UK economy is already struggling. And that created a whole sort of amount of reaction, and we'll show some of that in a second. But the IMF came out and said, that's a really dumb policy. You're likely to increase inequality and add to pressure to push up prices. In other words, interest rates will have to go even higher. And then, of course, the Bank of England came out last week and said, okay, we're going to have to intervene in the market here because of financial stability issues. And so they announced that they were going to purchase long-dated UK government bonds from the 28th of December for a couple of weeks, up to $5 billion a day. And then they also went on to say, but of course, we're looking to do quantitative tightening later. So our $80 billion stock reduction is unaffected. So you've got the Bank of England on the accelerator and the brake at the same time. They're doing quantitative tightening, they're doing quantitative easing later. Quantitative easing now and quantitative tightening later. And I actually put a tweet out last week saying, well, we could be close to a Lehman's moment because you've got this craziness going on. And the interesting observation and what's driving this is the long-term bonds. And if you go to the next slide, you can see there that this is the UK 30-year bonds. Now, the price of the bonds, and of course, price and yield goes in alternative ways. So the price was dropping dramatically. In fact, the yield went from around 3 and a bit to 5.5, right? Now, the reason this is critical is that there's 1 trillion of bonds in the UK held particularly by the pensions sector in the UK, right? And what they were doing were effectively using their long-term bond positions to effectively buttress and support payments to pension holders or superannuation holders in the UK, right? Now, because the movement in the market, the value of those bonds dropped by up to half in a couple of weeks. And so they basically ended up with a liquidity problem. The only way they could solve the liquidity problem was to sell more bonds. So that was what was actually there. So the Bank of England essentially had to react to that. And so they started then buying bonds. And you see the price came back. So it's sort of sitting at 3.85, which is still higher than where it was, but not as high as it was. And so that was the issue. So the Bank of England intervened specifically to solve a financial stability problem, because basically they propped up the UK pensions. That's going to cost them £60 billion, £60 billion roughly, if they go on doing it over the period. And then they said they're going to stop later. Now, what happens when they stop? Good question. We don't know. Then if you look at the next slide, that moved markets as well, because basically the pound dropped against the dollar when the UK government made their announcements. So actually, they were very high-level announcements. And then the pound came back when the Bank of England intervened. Now, put those bond and exchange rate issues together, you can see the instability that we've actually got. And I thought Zero Hedge put this really well. They said there's a terminal dilemma facing us now. The question is, do you fight inflation and suffer market collapse and economic depression with millions laid off? Or Do you push to stabilize social order and employment with higher asset prices, but potentially create runaway hyperinflation? That's the dilemma they now face. They're trying, how can they do both? Because one requires, higher interest rates, the other lower interest rates. The answer, as I said earlier on, the answer is you could do more quantitative easing, so print more money, but keep interest rates going higher. And in fact, in the UK, the market is now expecting the Bank of England next time will lift interest rates by a full 1%.
Yeah, I'd say to people at home, think about this zero hedge headline and apply that to all different countries. Don't just think about the US or the UK. Think about these developing countries where this is the choice, and stabilize that social order is really, really important. And this is where we're starting to see political change, and we've seen varying results in those elections and whatnot. But just to touch on a few of those other things you said, when the UK come out and start cutting taxes, and a lot of it was on the wealthy as well, you got to remember, even if we're putting a bit more cash in everyone's pockets to help them buy these higher cost of goods, if there's the same amount of goods and you don't change the economy at all, make it more productive, or have more goods and services and so on, it's the same amount of goods, and now you've just put more money. If there's 5% more money because people are paying 5% less tax, what happens? They still spend that 5% extra on the same goods, and so you're perpetuating inflation. And that's when the bond market, everyone says, well, hold on, you're going to end up footing the bill for this, which means all these bonds, you're going to be issuing more and they're going to be worthless. And it's just this cycle, and that's why we saw such a strong reaction from the market. And some of these currencies that are very boring, they've been more volatile than Bitcoin and that sort of thing recently, which is always fun to see.
Yeah, and it's worth just saying that this trickle-down philosophy, which of course is what Reagan did in the 70s and Thatcher did to an extent as well. Although Thatcher had this view of, strong money, stable money, so she wasn't going to effectively borrow to support it, which is an interesting difference from where the current prime minister is. But this whole idea of trickle down has failed over 30 years, right? So there is no proof that it works. Now, there's a thing called the Laffer curve, which is effectively showing that if you actually drop top rate taxes, you might get more investment. But you can also make the other argument that actually, if you give a bit more money to the poor, they spend it directly. Whereas if you give it to the rich, they already got more money than they know what to do with. So they may not spend it. They may not do what you expect. So there's a real big question about the policy. But the financial markets were just completely horrified by this. And as you say, the inflationary pressures, that's why the Bank of England is looking perhaps to have to lift 1%. But it's a very important object lesson. And as you dead right to say, you can't just think about this in one economy. This is unfortunately happening in many, many economies now. We've got this sort of complete dilemma between wrestling with inflation on one hand, like lifting interest rates, and dealing with the fallout and consequences. And they're being pulled in two directions, accelerator and brake, and that's the problem.
All right, let's march on, Martin. So everyone's been talking about how strong the US dollar is. If you have a look at a chart, it's gone parabolic lately. I think we might have put in a top for at least a short while. But yeah, it's really hurting. Again, these are major currencies. These aren't cryptos that we're talking about moving 20% year to date.
No, absolutely. So the pound dropped 20%. Even the Aussie dollar's down, well, it's more than now than it was 10, 11%. So these are big moves. And it's because essentially the US dollar is still perceived as that center of gravity, the firm base. When everything else is going crazy, you don't buy crypto, you don't buy gold, silver, you buy the US dollar, right? All hail the mighty US dollar. And of course, the US economy benefits from that. Everybody else doesn't benefit because, of course, what that means is that if you actually are buying oil in US dollars, you're going to pay 10 or 20% more for it. So it feeds inflation. And so that's another inflationary factor that people, I think, have missed in terms of saying inflation is fixed. No, it's not, because of this exchange. And you might be right, maybe the US dollar has peaked, but there is a view that potentially it could go even higher.
And Eurozone inflation numbers have continued to come in hotter than expected.
Yeah, and this is the point. Look at all the major economies. So in the Eurozone, the latest data out on Friday showed that it was 10%, and even the core inflation number was way above target. So they're looking at 2%. So Eurozone inflation is massively a problem. They're going to have to put rates up. And the latest data from the US that came out at the end of last week also showed that PCE, core PCE, which is the one that everybody looks at, was higher again. So inflation in the US is not even being fixed at all, despite the fact that petroleum dropped dramatically. So, the oil has dropped over the last few months significantly. Other factors, and that includes rents, for example, and housing costs in the US, which are still rising very fast, and other things, cost of food and other things. So inflation has not been beat in the US, and all of those commentators who were claiming that we've passed the peak, well, this data suggests probably not. And of course, in Australia, we got monthly information. Now, it's a bit flaky, but it's actually quite significant that for the first time, we've now got an indication more frequently, and inflation's still pretty high. And in fact, core CPI, which is the one that everybody looks at, was at 6.2%. Now, 6.2%, that's in the same ballpark as the US is. So we have an inflationary problem here in Australia. And again, people are downplaying it. They're arguing that it's not that significant. And again, I'll highlight, despite the fact that the petroleum element has dropped. So we've got an issue. And remember, of course, that we are now losing the excise holiday that we had for a period of time on fuel. So fuel costs are going up. And we've got this exchange rate move against us. So the costs of oil as we import into Australia is going to remain high, and other import goods as well. And we import a lot of stuff. So our inflation is not under control at all.
Yeah, a few comments. I think I read the US have drawn down on the strategic petroleum reserves the most in decades as well now, which can kind of buffer that problem for a short time. And similar, I don't think we've seen the full effects in Australia yet, have we?
No, that's really the point. Yeah, I mean, the US has plenty of oil around the place. And of course, because of the fears of global recession, pretty much everywhere you look now, including in China, there's effectively a feeling that oil prices might all come back. In fact, to the point where OPEC Plus are now considering restricting production.
Yeah. They
So
want
it's
to. Yeah, those
able to keep the
countries,
price up.
countries in the OPEC nations, OPEC Plus now, as they call it, to include Russia, they want to keep oil high as one of their main sources of revenue. So they're looking to cut that production and keep oil at $100 a barrel if they can. Yeah.
And sneakily, there are some countries buying cheap oil from Russia and then selling it on.
Yeah.
So my point is, anybody who thinks that inflation is beat, just look at this. Look at the data of the last month. We have a major inflation issue. And it's just worth underscoring that both the Federal Reserve and the Bank of England and the Bank of New Zealand and the RBA have all said we have to get inflation under control because otherwise everybody loses, right? Yeah. So that's that. And in fact, the Federal Reserve in the last few weeks have said, even if the stock market drops, even if home prices drop, even if unemployment rises, those are necessary things that we have to live with because inflation has to be beaten. And although Philip Lowe in his last outing was, still saying the same sort of things about beating inflation, the markets here in Australia are thinking, well, maybe the RBA won't lift rates much higher. Well, on the data that we're seeing here and the forward view, I think 50 basis points tomorrow is the most likely outcome. So I'm afraid inflation is not being beat. Interest rates are going to go up.
All right. So you already mentioned 6.2% here in Australia. Did you want to elaborate more on any of the specific categories?
No. Well, let's go to the rental one. So if you look at rental on the next slide, it's very interesting that the ABS rental data doesn't show a huge rise, but new rents, in other words, the listed rents of new properties, has gone through the roof. This next chart shows. That means that we've got a huge flow in of higher rental inflation, which has got yet to feed into the CPI. And there's a lag of somewhere between 6 and 12 months. So this is another reason why I think that inflation in Australia is going to remain stubbornly high for a lot longer than many people think. And therefore, the RBA is going to have to keep at it. And that's why I think the markets are also talking about high rates, as we'll see in a second.
Consumer confidence is fairly low still, not much of a change.
Yeah, there's a slight uptick, and a few people were celebrating that, but it's still massively low. I mean, it's close to where we were a couple of years ago. People are beginning to find it quite difficult to make ends meet Not everybody, but some, and that's why consumer confidence is pretty low. Long term, it's gone up slightly again, but still in negative territory. We are not in a good position, but weirdly, on the next slide, retail actually was still quite strong. So some people are still spending a lot. Now, of course, some of that is simply you're having to spend more dollars to get the same as what you bought last month because the price has gone up. And the question is, will that continue? Well, with everything else that we're seeing at the moment with higher interest rates, and remember there's a lag between interest rates coming up and impact on households. My view is we'll start to see retail begin to wobble sideways and go down. But this is another reason why I think RBA is going to lift rates again.
Yeah. Home prices continuing to fall?
Yeah, so this is the September data from CoreLogic, just showing that there are further slides. Adelaide dropped, not hugely, but a little bit. Perth dropped. Melbourne and Sydney, but Brisbane was the one that dropped the most. Now, they're sort of saying, well, maybe the drop isn't quite as big as last month, although it's still pretty big. And essentially what we're seeing now is pretty much everywhere. But interestingly, some of the most significant drops are in the northern beaches of New South Wales. And in fact, I did a show yesterday on that. If people want to go across to my channel and have a look at it, where I looked at individual price movements. That's where people are actually in the more affluent areas. So what we're seeing is some of the more affluent properties, they're dropping faster than the average. So more property price falls ahead, I think. And anybody who thinks that, property markets are going to sort of turn around, well, higher interest rates, supply demand disequilibrium, there are more falls ahead, I think.
Yeah, and guys, the links to Martin's channel is always in the description down below if you want his more detailed, regular videos that he does on all this stuff. All right, so the interbank cash rate, we've still got a long way to go compared to what the market's pricing in.
Yeah, so this is actually 27. I picked this one because this was a high point last week. This is after the RBA, after the Bank of England reacted, right? And we got to the point where we were looking at February 24 rates. This is the cash rate at 4.23%, and 4.3% in June and July next year. So in other words, higher for longer. Now, the rates did come back a little bit, but they're still above 4%, and markets are still thinking the cash rate will be above 4% at the beginning of 2024, right? Remember that at the moment, the cash rate is, it's in the twos. If it goes to the fours, that's a huge uptick, another 2% on the average typical mortgage. That's a huge deal.
Absolutely. So you've outlined a few different scenarios here for us, Mark.
Yeah, so I use these three scenarios when I do my modelling. Look, there's a best case scenario that says rates just stay relatively low and we don't get a huge issue with regard to inflation and wages begin to move up. No recession in Australia. That's probably what the RBA would like to see. The base case, I think, is rates going to perhaps 3.5%, which would mean a mortgage rate of 6 or 7%. They're going to stay high in 2023. Inflation will stay above target through 23, but in 24 come down, but no recession in Australia. Might get a recession in some other places. The worst scenario is that rates go higher. We get recessions in Europe. I think that's almost certain. The US, possible. And we also get a recession here in Australia. Rates will be high, which means mortgage rates will be up to about 7% in some cases. Then they'll start to come down, but the damage will have been done. And those are my three scenarios. And then I apply those to home prices and basically say from today, on the best case scenario, over the next 2 or 3 years, you might see home prices pretty much go sideways. On the base case, which is my most likely case, we're talking 15 to 20% falls depending on houses or units. This is an average, of course, it varies by different locations. But the worst case, we're looking 34% down from where they currently are. That is, hopefully not going to happen, but there is a risk. And like I said, there's no expectation yet that people are going to stop their rate hiking cycles. The central banks around the world are fixated on it.
And similar story with markets, and I guess just quickly with all this stuff, it's great to have scenarios. These days, you can't really do accurate analysis based on the fundamentals because what happens really just depends on what the central banks do. If they step in and they say, "Oh, we can't let markets crash too bad," or "No, inflation's the priority as you've touched on, and we're going to have to let markets and everything else crash." That's the cost of doing business. Sorry, and it's just it's insane that we've let this debt-based system perpetuate to such a point where it's just back in the days. housing cycles were normal, business cycles were normal, but everything is so big now that they have
Yeah.
to continue to perpetuate this bubble, or everything is just this collapse waiting to happen.
Yeah, absolutely. And you're right. It's what central banks do. So everyone's now talking, well, will the Fed pivot? Will the RBA pivot, et cetera, et cetera. But what I said earlier on, I think it's important to underscore again. It could be that they go on lifting rates, but then do selective quantitative easing strategies to throw liquidity at particular point problems, right? I'm not sure we're going to ever see interest rates back down to where they were unless we get a huge, depressionary cycle, which would actually be another problem in itself. And there is, of course, the vague risk of negative rates eventually, but we'll see where that goes. But in the short term, expect rates to go higher. But the issue is the markets, right? And I've got this slide here which showed the markets as a Friday evening in Australia, 6,460, the ASX 200. So we're back to where we were in 2019. But with everything else that I've said, with the October effect, with higher interest rates, with all of the shenanigans in the bond markets, I think there's a very good probability that we're going to see the markets go significantly lower over the next few weeks. And unfortunately, October is the time of year when it's going to happen.
Final slide here, Martin. RBA
Yeah,
stats.
I just want to talk about this. This is the fact that the RBA is in negative equity. Now, they have wrecked their reputation, in my view, by taking interest rates too low, doing huge amounts of quantitative easing, the term funding facility, all of those things. They're now in the situation where they're paying banks 2 to 3% on money that they gave the banks for almost nothing some time ago, and the banks put it back in the exchange accounts. They're paying the banks, so the taxpayers are supporting the bank's profitability. The bank itself is in negative equity. Now, of course, if you were a standard commercial entity, you'd have gone bust. But of course, the RBA can't go bust. And it's funny money because on the other side of the equation, you've got the Treasury saying, well, we've got the other side of the bond. So you put the two together and it cancels out and there's nothing to see here, right? But this is a big deal. This shows, I think, that the RBA is really not, that accountable for what it does. And this is a big, big deal. Now, they argue that eventually, of course, the bonds will get paid back at par and then it'll all get washed out. But this 30-something number was before the latest bond movements. So my expectation is that next time the Reserve Bank reports on its financial conditions, I wouldn't be surprised to see a bigger negative equity thing. This is nonsensical. So the inquiry in the Reserve Bank's dead right, needs to be there. There's a big, big question about central banks more generally, which have really, I think, stuffed up the economy over the last 20 to 30 years. The risk that I see is they're going to do it more again. They're going to throw more liquidity in. They're going to do more quantitative easing and point solutions to try and solve the problem, whilst at the same time trying to lift interest rates to effectively deal with inflation. And the analogy I keep using is we're riding the accelerator and the brake at the same time. And when you do that, the journey is not very comfortable.
Yeah, I guess for people at home, we kind of got a taste of this, was it 12 months or so ago when they were conducting those open market operations in Australia to try and cap yields, and they lost so much money, tens of billions of dollars doing it. That's what we're seeing now in the great British pound, and we might see again in Australia. So, as Martin says, it's not like a commercial bank that can be insolvent. They can always print more money, but the cost is that of your sovereign currency. And that's why we're seeing the pound, the Aussie dollar. So, yeah, if they're trying to fight this inflation while keeping interest rates high and trying to cap those bond yields, it's going to be this spray hose. We touched on that GFC bailout figure of what was that first rescue package was about 700 billion from memory. And the markets have got a lot bigger than this. So if they go down that path that we've been talking about kind of trying to do both and say, oh, things aren't that bad and, oh, it's not really QE, they'll probably call it something else. The packages they're going to be doing, and this is going to roll into the trillions very, very quickly. And that's when, again, it's all relative to what currencies happen and if the US have to do it and extend those swap lines. And that's where, obviously, as a Bitcoin believer or a gold believer, whatever you are, these things that are fixed, if fiat currencies are just starting to get printed at an even more aggressive rate, that's when those narratives come into the fold as well. But that's just my beliefs, Martin.
Well, but the point there, of course, is that if you've got Bitcoin, it's more tracking the markets than previously. And so people maybe say there's some downside risk there. And even gold and silver, they've not done particularly well either in terms of hedges against inflation. So the
Yes.
point is, there is really nowhere to hide. And our financial system is being wrecked by central banks doing what they're doing. They are not actually part of the solution. They're part of the problem.
Yes.
So I think we should think very hard about what central banks should be doing and how they should be managed. I'm not sure that the inquiry we've got running on for the bank RBA is actually going to get to the heart of it. But there's a really big set of questions that I think we should be asking, and not just saying all hail to the great central bank, in godlike form. They know precisely what they're doing. They don't. These are experiments, and frankly, the last 20 years have led us up a garden path, and I'm not sure we can see the exit clearly. So it's going to be a really bumpy ride.
Yeah, we haven't even touched on some of the energy situations going on and what's happening. This is definitely the most interesting time to be alive. So, Martin, it's probably a good thing there's only, 26 days or whatever to our next video. So I look forward to talking to you next month.
Plenty to talk about next time, absolutely.
Thanks a lot. Cheers, guys.
Cheers.
Bye.